He's a fan favorite. Jim Rickards is back this year for our Outlook 2015. He's also the best-selling author of Currency Wars and the Death of Money. Jim Rickards, always good to be reunited with you.
Thank you, Danielle. It's great to be with you.
And how fitting to have the author of Currency Wars, because as we end the year, Jim, could we be on the brink of a currency war? It seems that way.
Yeah, we're absolutely in a currency war. And you're right, it's making quite a few headlines these days. But what I explain to people is that this is not a new currency war. This is the same currency war that started in 2010. I wrote about my first book, Currency Wars, which came out in 2011. It's the same war. And one of the points I made in the book is that we're not always in a currency war, but when we are, they can go on for 5 or 10 or 15 or even 20 years.
Now, Jim, last time you were on, we spoke a lot about the Fed. And many analysts expect that with the stronger U.S. data we're seeing, that the Fed may raise rates now sooner than later. Jim, have any of your views changed with the stronger data we're seeing?
We've created over 300,000 jobs per month. A couple of years ago, we had 4% GDP. A couple of years ago, at the end of 2011, early 2012. And what happened in both cases? It faded. It went back down to this trend of, certainly below 200,000 job creation and economic growth, real growth below 2%. So let's see if this is sustained. It is good news lately, no doubt about it. But my expectation is that in the months ahead, some of these numbers will get weaker. Some of the numbers will be revised downward. We'll see that we haven't really broken out of this low growth trend. It's not a no growth or negative growth trend. The economy's not collapsing. It's just not growing up to potential. And as long as that's true, as long as deflation is on the horizon, which it is, particularly with oil prices, and we can talk more about that, the Fed's not going to raise rates.
Jim, you were also not ruling out the possibility of a QE4. Do you think we'll see some sort of stimulus introduced in the U.S. in 2015?
Maybe in 2015. It'll be late in 2015. Maybe the first quarter of 2016 is a better forecast for that. The reason, Danielle, remember, the Fed has just finished tapering QE3, but it wasn't the first taper. When QE1 was over, you can think of that as a 100% taper. When QE2 was over, you can think of that as a 100% taper. Now QE3 is over. We've had a 100% taper. What we know about tapering is it failed. QE1 failed. They had to come back with QE2. QE2 failed, they had to come back with QE3. But if you look at the gaps, QE2 was over in June 2011. QE3 did not begin until September 2012. So that was a 14-month gap. If growth goes as I expect, and if we see this continued depressed growth, I would expect you might see QE4 in, say, early 2016.
Now, Jim, just getting back to currency wars, do you think that in 2015 we'll see the euro and the yen depreciate in value and the U.S. dollar continue its dominance? Well,
it's a little bit of a mixed bag. Whenever you talk about currencies, you always have to say compared to what. But you make a very good point, Danielle, which everything's a cross rate. You can't have a weak yen, a weak euro, and a weak dollar all at the same time. Now, I do expect the yen to go lower. I expect it to go maybe even as far as 140. That would not surprise me at all. They wanted to cheapen the yen. Everyone says this to promote exports. That's not the reason. The reason is to import inflation in the form of higher energy prices. So it's a moving target. The Japanese just can't win. I mean, they got the yen cheaper, but then oil went cheaper, and so they didn't get the imported inflation they want because the dollar price of oil went down. So with a lower dollar price of oil, you need a lower yen to get the inflation. So I look for the yen at 140. Euro's an interesting story. Their economy has its problems, but they're not in as bad shape as the Japanese. And I think the real story is that the U.S. economy, as I said earlier, is not as strong as the Fed believes, not as strong as most market participants believe. I see a lot of weakness. And so for now, yes, the strong dollar prevails, but by the middle of 2015 to late 2015, I think the U.S. is going to be the one that needs the help, and that probably comes at the expense of Europe. That's why they're so desperate to get QE in Europe, because they think Europe needs a little help. So the euro might be at a low. I think the yen will go lower, maybe to 140. But I do look for the dollar to start to weaken late next year, and that's going to, when people realize the Fed's not going to raise rates, that's going to pull the rug out from under the dollar.
Let's talk gold now. And with 2015 around the corner, some have brought back Nouriel Roubini's prediction of $1,000 gold in 2015. Now, I remember when Professor Roubini made that claim, you had a bit of a Twitter battle with him. Do you think that this forecast could come true?
Well, look, you could see $1,000 gold on the way to $5,000 gold. The point is, my target, my intermediate to longer term target for gold is still in that $5,000 to $7,000 range. That has to do with the loss of confidence in paper money and the possibility that you would somehow have to use gold in some way, either a strict gold standard or some gold reference, in order to restore confidence in paper money. To do that in a non-deflationary way, to do it in a way that does not repeat the mistakes of the 1920s and the 1930s, you'd have to get to that $5,000 to $7,000 level. And I talked to Jim Rogers recently. I know he's been on your show, and he makes the point, nothing has gone to its full height without a 50% retracement along the way. The top for gold was 1900, so a 50% retracement would put it at 950. I'm not predicting 950 gold, but that would not be unusual. My concern for investors is that when it really takes off, when it starts gapping up, $200-$300 an ounce per week, and all of a sudden, a couple of weeks go by and it's up a couple $1,000, and people wake up and say, oh, gee, I better get some gold. You're not going to be able to find it. So I recommend getting it now when it is available, before it runs out. That'll be the problem. When the price really takes off, you won't be able to get it.
Thank you, Jim. Happy holidays and be safe. And to all our viewers, happy holidays to you as well. We thank you for your support and we wish you a very happy and healthy 2015. Thanks for watching.